Hi and welcome to Swissquote's Daily Market Talk. It's Monday, November 17th. Markets are on edge. AI worries continue. The Fed is no longer sure to deliver that 25 basis point cut next month. Dip buyers pushed the S&P 500 above its 50-day moving average just before the closing bell last Friday, while the SMI in Switzerland hardly moved after the announcement of lower tariffs with the US. So the franc is approaching the levels of alarming strength as no other asset out there is providing the safety that investors want today, not gold and even less Bitcoin. So with data and Nvidia earnings waiting to join in, volatility in the markets will certainly be on the menu of the week. That could be a make or break one just before the Christmas vibes kick in. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So let's first talk about Switzerland. The Swiss are known to be slow. The proof is, it took the Palais Fédéral a few months to acclimate to the new diplomacy and send, instead of Karine Keller-Sutter, who's sometimes quite irritating to be honest and would never ever kiss a ring, a handful of rich businessmen with loads of gifts in their hands ranging from Rolex watches to gold bars reportedly specifically cut for President Trump to make these negotiations and make this deal happen. And the magic happened. The Swiss export tariffs toward the US have been pulled from 39% to 15%. So anything that's for sale, the Swiss could buy. But make no mistake, at Friday's apéro last week, the good news from the US tariffs front was counterweighted by the franc's persistent strength. The strong franc sure sounds like a first world problem. And it is, it really is, but it does have concrete negative implications for businesses still. While iPhones, toys, cars, and whatever you can think of made outside Switzerland will be, costing peanuts for the Swiss this Christmas, as it is the case for every other Christmas, it is, on the other hand, hurting demand and costing jobs to Swiss people, because your Gruyere cheese could be the best of its kind, but when it costs nearly $40 a kilo, it kind of gets hard to digest. So this is why your SMI index didn't really know how to react to the latest news last Friday and where to go from here on the good news normally. So it gapped lower at Friday's open, then it went up and down and up again, but nothing showing that the clouds have dissipated. So what's next? Can the Swiss franc appreciate infinitely? Well, the answer seems to be yes, it can. The Swiss National Bank pulled its rates to 0% this year, and the latest data suggested that the Swiss National Bank actually attempted to intervene in the FX markets by directly selling Swiss francs to weaken it. Nothing worked. From here, I think there is a bigger chance, a greater chance of direct FX interventions from the SNB than another rate cut, especially this year. Now, there is no guarantee that the latter, the FX interventions, reverse the franc's appreciation, but what makes the Swiss National Bank so very much credible is that the Swiss National Bank can print as many francs as it wants and sell them. And the euro franc is definitely walking along the 0.92 level this morning, a level that seems to be bringing the Swiss National Bank in. And the reason why the Swiss franc is so very much strong is because appetite for other currencies is not. And even gold doesn't offer the peace of mind to investors today in times of market turbulence and rising market stress. And the US dollar, on the other hand, is better bid this morning in Asia, as the US will finally provide some economic data to hungry and thirsty investors to chew something into the December meeting of the Federal Reserve. But the probability for a 25 basis point cut in December from the Fed melted to 43% from above 90% in the wake of the US government shutdown. So there is now quite a large space for the Fed those to jump back in. But for that to happen, the jobs data from the US that's due this Thursday should be soft enough to reverse the no-cut pricing. But what's soft enough is hard to say this morning, as there are no forecasts available for the September jobs data for the US. So my analysis here is we will see. Last week ended on a slightly positive note as dip buyers jumped in before the weekly closing bell and helped the S&P 500 close last week above its 50-day moving average. Nasdaq futures, on the other hand, are leading the gains this morning at the time I'm talking here on hope that Nvidia will be throwing strong results on the table this Wednesday to push the bears away. And the company's CEO Jensen Huang sounds so sure of himself that the numbers won't fall behind. They cannot fall behind. The question is, will investors keep buying though? Whereas possibly. Why not? The latest news actually suggests that Warren Buffett's Berkshire Hathaway actually did build a new stake in Google and Michael Burry closed his fund. So possibly there is more air to be pumped in here. So the other question is, would improved appetite for tech eventually save Bitcoin? Well, the answer is, I don't know. I don't talk about Bitcoin quite often because, well, it rarely moves on anything tangible and the latter really annoys me. But what's sure is that momentum is Bitcoin's big friend and it is pointing at deeper losses at the moment. How deep? Well, my Fibonacci retracement on 2023-2025 rally says that it could sink down to around 82 to 83,000 US dollar mark without damaging the past 2 years bullish trend. Then, again, I don't know. As long as we don't use our Bitcoins to buy things, buy cars, houses, or grocery, I can't say what besides the dream of making easy money could hold it there. And I'm afraid if people lose money, countries might step in to protect people from the devil as they've done with leveraged currency trading years ago, remember? That sucks, but that's what governments do. But my best guess here is that the blockchain technology will do fine with or without Bitcoin. Because if you missed the memo, JP Morgan has now rolled out its very own deposit token called JPM coin that, unlike Bitcoin, that is backed by thin air basically, will represent US dollar deposits sitting safely inside JP Morgan. And why is it cool? It's cool because these tokens will slash settlement times, boost liquidity, and wait for it, let clients operate 24/7. Yes, you heard that correctly. Real-time, round-the-clock movement of money, not whatever we want to call the current system that shuts down on weekends like it is 1998. And this is yet another giant domino falling toward the institutionalization of tokenized money. In 10 years from now, it might not be Bitcoin that replaces money, but tokens that quietly rewire the entire financial system. And honestly, we will only be happy about that change because one day we will simply look back and say, oh, remember when payments took 2 days, 2 entire working days, and the system went to sleep on weekends. How absurd that was. So let's see what happens, but I still believe in blockchain even though Bitcoin just loses some ground. So the week that we are about to enter now is serving up a mix of US data, a fresh round of European and UK inflation numbers, and a handful of earnings to keep everyone on their toes, from Nvidia to Alibaba and Baidu and the US big retail names. So will the new data and news nudge expectations back towards dovish territory, especially for the Fed, and give sentiment a lift, or will it quietly shush the bulls and keep markets on mute? Either way, we're about to find out and have a volatile week. So it will be fun. Stay tuned. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful comments. I hope this episode of Market Talk has been helpful and has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.